Hello, my friends, my dear financial warriors and soon-to-be liquidated leaks. Boss Economics here, broadcasting live from the heart of the Matrix on this beautiful September 9th, 2025. Grab your coffee, or maybe something stronger, because the story today is a real doozy. It's a tale of champagne, caviar, and a party so loud it's shaking the foundations of the global economy. The headline screaming across every terminal from Wall Street to the City of London? Global bonds surge over 20% from 2022 trough. That's right. The Bloomberg Global Ag Index, that big, beautiful basket of global IOs, is singing like a canary. It's at its highest point since March 2022. For those of you who've been in a coma, the period between 2022 and 2024 was what we affectionately call the Great Bond Carnage, a time when holding government debt felt less like a safe haven and more like catching a falling knife made of fiscal irresponsibility. Your safe bond fund was bleeding more red ink than a horror movie. But now? The party is back on. The DJ is spinning, the punch bowl is being refilled, and everyone is dancing. But as your trusted guide through this economic circus, I'm here to tell you to look past the disco ball and flashing lights. We need to ask the real questions. Who's the DJ? What's in the punch? And who's going to be left cleaning up the mess when the music inevitably stops? Let's break it down, from the dizzying highs to the terrifying lows lurking just beneath the surface. The immediate cause of this bond market euphoria is simpler than a politician's promise. The Federal Reserve is about to hit the brakes and throw the car into reverse. For the last 3 years, we've lived under the iron fist of Jerome Powell and his band of merry inflation fighters. They jacked up rates with the ferocity of a lumberjack on stimulants, trying to slay the inflation dragon they themselves helped create with years of zero interest rate policy and quantitative easing. The medicine, as always, was painful. It choked off growth, sent the bond market into a tailspin, and made the cost of everything from a mortgage to a car loan feel like a ransom note. But now, the data is telling a different story. The latest U.S. labor report for August 2025 was a certified dud. The non-farm payrolls number came in at a measly 50,000 new jobs. The market was expecting 150,000. That's not a gentle cooling, that's the labor market stepping into a walk-in freezer. Wage growth has stalled, and the unemployment rate has ticked up to 4.2%, its highest level in 3 years. And inflation? The consumer price index is now hovering around a sleepy 1.8%, and it has been stubbornly below the Fed's sacred 2% target for the third consecutive month. They overcorrected, folks. It's the classic central banker two-step: slam on the brakes so hard you fly through the windshield, then panic and floor the accelerator to get back on the road. The market, smelling blood in the water, is now pricing in a near 100% certainty of a rate cut at the Fed meeting next week. The only question is how big. The sane money is on a 25 basis point cut. But the real cowboys, the ones high on hopium, are whispering about a 50 basis point shock and awe cut to kickstart the economy. They're not just asking for a drink, they're trying to grab the whole bottle of whiskey from behind the bar. This, my friends, is what my contact at Westpac, Martin Wetton, calls a grab for yield. When the Fed signals it's about to make money cheap again, bond prices go up. Investors who were shorting the market, betting that prices would fall, are now getting squeezed into oblivion, forced to buy back bonds at higher prices, adding fuel to the fire. It's a stampede. Everyone is rushing to lock in today's yields before they vanish into the coming era of cheaper money. This isn't just an American party. The Fed is the lead DJ for the entire planet. When they change the music, every other central bank in the G7 starts tapping its feet to the same rhythm. The European Central Bank, facing a stagnant German manufacturing sector and an Italian economy that's perpetually on the brink, has already started whispering sweet nothings about its own easing cycle. The Bank of England, staring down the barrel of anemic growth, is right behind them. The result is a worldwide bond rally. German bonds, UK gilts, even Japanese government bonds are catching a bid. And the thirst for yield is pushing investors into riskier assets. Look at the corporate debt market. Just last week, Global Megacorp, a company with a credit rating that's just a notch above a handwritten IOU on a napkin, managed to issue a 10-year bond with a yield that would have been considered science fiction 2 years ago. The spread between junk bonds and safe haven government debt has compressed to levels we haven't seen since the ZIRP fever dream of 2021. This is the beautiful, seductive part of the cycle. Asset prices go up. Your 401k looks healthier. It feels like winning. It feels like the good times are back. But now, it's time to turn over the rock and see what's crawling underneath. Okay, take a deep breath. We've had our fun with the sugar rush. Now for the dose of reality that your friendly neighborhood financial advisor is too scared to tell you. While the central bankers are busy refilling the punch bowl with liquidity, another group of people are busy drilling holes in the floor. I'm talking about the politicians. The core conflict of our economic era is this: monetary policy is easing, while fiscal discipline has completely evaporated. This is a recipe for a disaster of epic proportions. The short-term bond rally is nothing more than a beautiful curtain hiding a rotten, crumbling stage. Let's take a quick tour of the fiscal clown circus. Exhibit A, France, the Après-moi, Le Deluge School of Economics. Just last week, the French premier went on television and uttered the forbidden words, debt crisis. He's not being dramatic. France's debt-to-GDP ratio is now hurtling towards 120%. Their budget deficit is stubbornly stuck above 5% of GDP. The spread between French and German 10-year bonds, a key indicator of market fear, is now trading with a croissant premium wider than the Champs-Élysées. The French government is trapped. The public demands generous social spending, early retirements, and short work weeks. The markets demand fiscal discipline. So, what do? They promise both, of course. They are like a Michelin-starred chef who keeps ordering caviar and truffles for the kitchen but forgets to charge the customers. It's a fantastic meal right up until the moment the bailiffs show up to repossess the ovens. Exhibit B, the United Kingdom, a perpetual balancing act on a unicycle. Across the channel, Chancellor Rachel Reeves is preparing her big November budget. And she is walking the thinnest of tightropes. The British public, battered by years of austerity and inflation, wants tax cuts and a fire hose of cash for the beloved National Health Service. But the gilt market vigilantes, the bond traders who famously blew up Liz Truss's premiership in 2022 for a similar fantasy budget, are watching. They have their fingers on the sell button. The UK's national debt has surpassed 100% of GDP for the first time since the 1960s. Their projected deficit for this year is, once again, hovering around 5%. They are trying to promise a fiscal diet while secretly binge-eating cake in the pantry. Every pound of spending restraint they announce is matched by a new growth initiative that costs too. It's not sustainable, and the market knows it. Exhibit C, Japan, the grandfather of fiscal insanity. And then there's Japan. Oh, Japan. They are the true pioneers, the sensei of kicking the can down the road. They've kicked that can so far it has achieved escape velocity and is now orbiting Jupiter. Their debt-to-GDP ratio is a truly mind-boggling 270%. The Bank of Japan has become the country's biggest creditor, owning over half of all outstanding government bonds. This isn't a free market anymore, it's a closed-loop system where the government issues debt and the central bank prints money to buy it. It's a family squabble where the son owes his mother an astronomical allowance, and she just keeps giving him a bigger credit card. Now, Prime Minister Shigeru Ishiba, who at least paid lip service to fiscal discipline, has announced he's stepping down. The market is terrified that his successor will be an even more enthusiastic devotee of the magic money tree theory of economics. The day his resignation was announced, the yield on the 40-year JGB ticked up, a tiny tremor from a market that is deeply, deeply afraid of what comes next. So, what happens when you put all this together? You get a system that is fundamentally, terrifyingly unstable. Think of it this way, the Fed and other central banks are pouring water onto the economic engine to keep it from overheating and stalling. At the exact same time, governments in the US, Europe, and Japan are flooring the fiscal gas pedal. What happens when you pour water on an engine while flooring the gas? You get a whole lot of steam, a lot of noise, and eventually, a catastrophic failure. The current bond rally is the steam. It's the market's temporary belief that the cool water from the central banks can solve the problem. Traders are focused on the 25 or 50 basis points the Fed will cut next week. They are ignoring the trillions in new debt that the US Treasury, the French Treasurer, and the UK Debt Management Office will have to issue next year, and the year after that, and the year after that. Who is going to buy all this new debt, especially when interest rates are falling again? For now, the answer is investors chasing the rally. But eventually, the sheer volume of supply will overwhelm demand. This is the moment of truth. This is when the so-called bond market vigilantes wake from their slumber. They will look at the mountain of debt, the pathetic yields on offer, and the deteriorating creditworthiness of entire nations, and they will say, no more. They will demand higher yields to compensate for the massive risk. And that, my friends, is when the party ends. A spike in long-term bond yields, driven by fiscal fears, would crash the stock market, detonate the housing market, and force governments into brutal austerity measures, likely triggering a deep recession. It's a doom loop. 1. Government spends more to appease voters. 2. Issues more debt to pay for it. 3. Market gets nervous and demands higher interest on that debt. 4. Government's interest payments explode, forcing it to issue even more debt. 5. Repeat until the system breaks. So, what does this all mean for you, my friend, holding a few ETFs and a mortgage? It means we are living in a paradox. The very thing that is making your portfolio look good in the short term, the prospect of central bank rate cuts, is a response to economic weakness and is enabling the long-term fiscal rot that threatens to bring the whole system down. The 20% surge in the global bond index isn't a sign of a healthy, robust recovery. It's the feverish, giddy feeling you get before the illness truly takes hold. It's the market celebrating the return of the cheap money drug, without acknowledging that the patient is sicker than ever. So, what's the play? Enjoy the party, but keep your coat on and know where the exits are. This Fed-induced rally might have legs for a few more months, maybe even into next year. But don't be fooled into thinking the fundamental problems have been solved. They have been papered over with freshly printed money and political platitudes. The real story of 2025 isn't the bond rally. It's the Titanic, slow-motion collision between central bankers trying to keep the game going and politicians who have forgotten how to balance a checkbook. When the music stops this time, it won't be a gentle fade out. It will be a record scratch followed by the deafening sound of sirens. This is Boss Economics, reminding you to watch the sovereign debt clock, not just the stock ticker. The numbers on that clock are getting bigger, and they are the ones that will ultimately matter. Stay sharp. Don't be the leak. Until next time.